Well, still high but slowing. A better than feared inflation report boosting stocks today. April's headline figure grew at 4.9% on an annual basis. That's the smallest 12-month rise since April of 2021 and the first reading below 5% in 2 years. Now, the core number, however, is still holding tight at 5.5%, and that's the key for the Fed's policy. Yahoo Finance's Jennifer Schonberger is here with more. Hey, Jennifer.
Good morning, Rochelle. That's right. With the reading on that headline number dropping below that key level of 5%, that was encouraging, though the core level remaining sticky, though not getting worse. And for that reason, many on Wall Street think that this number alone may not nudge the Fed higher to raise rates higher. Take a look at the Fed funds futures this morning. They've been pretty volatile as of 10:50 a.m., pricing in about a 8.5% chance of a rate hike in June. It was as high as 13% earlier in the morning. More so, we're going to get another read on CPI and a PCE, the Fed's preferred read on inflation, before the Fed meets again in mid-June. So a lot more data to come. But this morning, bond portfolio manager from Wilmington Trust, Will Stith, telling me that the CPI number fosters more of a pause for the Fed, but not by much. Net, he says it paints a narrative that things are continuing to move at a slower pace gradually. Meanwhile, capital economics economist Andrew Hunter wrote in a research note, quote, "We don't think that this will persuade the Fed to hike again at the June FOMC meeting, but it does suggest a risk that rates will need to remain high for a little longer than we have assumed." Now, taking a dive into that number, while the headline figure continues to drop, the core rate has remained sticky this year, oscillating between 5.5% and 5.6% this year, down from about 5.7% at the end of last year. But Fed officials expect a slowdown in rents to come that will eventually show up in these calculations, causing core inflation to fall. And that's something that New York Fed President John Williams attested to in a speech on Tuesday, though he also said that so-called core services excluding housing shows inflation is still sticky, which we saw very much in this report. He says that's being driven by an imbalance in supply and demand. Now, juxtapose this with the fact that Fed officials are also looking closely at credit conditions, which have been tightening to see if that may offset pressure of inflation in this economy. We got evidence of further tightening in credit conditions in a survey on Sunday. And Chicago Fed President Austin Goolsbee told me in an interview on Monday that he thinks we're at the very beginning stages of a credit squeeze. Of course, the magnitude of that remains to be seen. Nevertheless, we're at a point right now, New York Fed President John Williams says that they're not giving explicit forward guidance on interest rates. However, taking this report in stride alone, it doesn't appear that it could nudge the Fed higher. Of course, again, Rochelle, a lot of data expected between now and the middle of June. Back to you.
So certainly explains why we've seen that sort of mixed picture that we're seeing in the market reaction. Yeah. Appreciate that update. Jennifer Schonberger there for us.